Hello everyone, this is Joel Solomon of PRS and the Roadmap. I want you to forgive a little bit of laryngitis, but I wanted to get this recorded for some original training, and later on we'll update the recording. So when you log on to your private access to the Roadmap web-based version, you'll see this particular screen. What you're going to do is click on that screen and you'll have your own personal login. You'll click on the login button. This screen pops up, which is our welcome screen, and you can actually use this with clients. And it basically talks about the retirement objectives that people have. To be prepared for retirement, you first need to establish your after-tax retirement income goal adjusted for inflation, and determine if your retirement assets are sufficient to meet your goal. And if you're not on track, how are we going to create that financial security in a tax-efficient manner? So for any of you that want to do this in front of a client, this page, not reading it word for word, will actually allow you to do so. But in terms of just doing the input, you're going to click on down here, continue to enter your roadmap assumptions. Now, there are a number of tabs up on top. You'll see Client Profile, Retirement Planner, Widow Planner, College Planner. So today, I'm going to go over the Retirement Planner first. So what you're going to do is you're going to put in the name of your client. So we'll call this guy Bob, and we'll call him Johnson. And let's just suppose he's a 45-year-old individual. Again, you would select male or female, in this case male, and there's a drop-down menu for whatever state is that you're working on. We're now going to shift our focus to client retirement income goals. Here, you'll see it says uninflated income requirement at retirement. This is an after-tax number. So let's suppose our client's goal is $100,000 and he wants to assume a 2.5% inflation rate. Now there's a couple ways to do this input. You can put the cursor on this side, drag it over so it's all highlighted, and put in 2.5%. That's the way that I like to do it. Put the cursor to the right, drag it to the left, and then put in whatever you want to put in. Now, we have three retirement periods, what we call go-go, which is the active period, a slow-go period, and a no-go period. At first, what we like to do is pick our beginning retirement age. Now, our web-based roadmap allows you to pick any retirement age that you want. But to keep things simple, let's start off with an age 65 retirement. And now I'm going to go down to the no-go period, and I'm going to say I want my retirement to end at age 92. So this is the entry right down here. If I don't want to reduce the amount of income that I'm going to need during retirement, in other words, if I just want $100,000 after-tax income adjusted for inflation at 2.5%, what we're going to do is in our go-go retirement period, the defaults go, in this example, to 75. So if my beginning retirement age was 65, I'll leave the ending go-go to be 75. Now you'll notice it says go-go income percentage of our uninflated goal, 100%. So what this is saying is during this go-go retirement age, I want $100,000 of this goal. Now, slow-go is a slowing down period. You have the ability to reduce the amount that somebody's getting, because they normally, as they go through retirement, will be spending less, they'll be traveling less. But again, for my first example, I'm going to keep my goal at 100% of what I was receiving during my go-go period. So notice what this says. What percentage of my go-go income do I want during my slow go? So if I leave this at 100%, I'm going to get 100% of what I was getting during the go-go period. And the same applies for my no-go period. I just want $100,000 inflating at 2.5%, beginning at 65 and ending at 92. Now, if I go this route, just a $100,000 goal all the way out, so the critical ages are what I input right here for my beginning period, and I would only make a change at the ending period of retirement where I expect him to die. Again, you can run it to 100, 95, whatever number you want. But in my example, let's just end it at age 90. We'll kill him at 90. So those are your retirement inputs. Now, I will come back and do another example later on. So the first thing that I always like to do with a client is just look at the goal without any consideration for what he has in his tax qualified plan or other retirement assets. Now, our program allows you to include Social Security, but for these inputs out of the gate, I'm going to not consider Social Security, so it's checked no. Now, an important number for our calculations, and that is this. We want under the Other Retirement Assets tab, it says assumed after-tax rate of return on other assets. If there is a retirement deficiency, this is the number, this is the earnings assumption that the web-based roadmap is going to use to calculate a deficiency and how much somebody would need to save in order to meet their retirement capital deficiency. Our default is 4% after tax on invested assets. Now, our other assumptions are for taxes. So we use what's called an effective tax rate, total taxes divided by total income. It's not a marginal tax rate, it's an effective tax rate. And we use a 35% assumption during the income earning period. And frankly, this has absolutely no impact on any of the calculations. What does have an impact on the calculations is the effective tax rate at retirement, because any money coming out of a tax qualified plan will be reduced by the amount of this percentage that we're going to use as a tax rate. So if somebody was going to get $100,000 out of an IRA or a 401k, and if we used a 30% effective tax rate, that would generate a $30,000 tax, which you would see in the roadmap output. But again, in our first example, we're not assuming any tax qualified assets or any other assets. So the important ingredient is what we use as our assumed after-tax rate of return. So let's hit save and continue and see what we get. The first thing we get is a profile preview. Are these inputs correct? And you just see a regurgitation of all of your inputs. Our $100,000 goal, 2.5% inflation, and the fact that retirement is beginning at 65, and for the go-go, slow-go, and no-go periods, again with death occurring at 90, we're getting 100% of what we were getting in the prior period. So that's another way of saying this is a $100,000 goal all the way out, growing with inflation. We've assumed no assets. Here's our 4% after-tax rate of return assumption. Now we're going to click on Yes, Generate Roadmap Results. Nothing is calculating on your computer. This is going out into the internet on our secure servers, processing and coming back to you in 1/1000th of a second. The only thing you need is high-speed internet access to do this. Now, notice where my cursor is. So I'm moving my cursor around, and if I left mouse click, you'll see that it will highlight things. I don't really use that very often, but I'm just showing you the impact. On the right side here, you'll see our after-tax retirement income adjusted for inflation goal. You'll see it says our goal is $100,000, but again, he's not at retirement. He's at age 45 today. So we have a scroll bar. You see it highlight. So all I've done is move my cursor over to the scroll bar, and what I can do by pulling down the scroll bar is you'll see I'm showing him the impact of inflation. And I will typically move this up until I reach my retirement income age, which, as you'll see, is highlighted here at 65. If he was retiring at 67, you would see this gold line going through age 67. So what this means is, Mr. Client, you would need $164,000 of after-tax income to buy $100,000 of inflation-adjusted services. Now, I will continue to scroll this down, and as you see, if I kind of run out of room, what I have to do is move this up. So there are ways that we do move this up, and one of the things that I like to do is go up to my my zoomer here, and if I make it just a little bit smaller, you see that I actually can find what I need. So you want to make sure in your screen display that you have in your Safari or whatever your internet browser is, these two little icons that allow you to make the screen smaller or make it larger. And I use this all of the time. So what we're seeing here, Mr. Client, from age 65, notice how I'm using the scroll bar. Now, I can also go, I will just repeat that the scroll bar is the best way to do this. So from age 65, Mr. Client, I'll grab the scroll bar again, pull it down, all the way through and including age 90. You would actually need assets that can deliver $5.9 million of cumulative after-tax retirement income. Does that surprise you? I'll give them a chance to think about it, and then at that point, I'm going to click directly on step 5. I'm going to click on it. Now, what step 5 shows is how we got to that $5.9 million number that you see right here. Here's his $100,000 after-tax goal, adjusting for inflation. You'll also see 3 different shades of the chart, which would reflect the go-go period, the slow-go period, and the no-go period. Again, in my first example, there's no reduction of my retirement income goal during my slow-go period or my no-go period. I'll show you how to make those reductions and the impact a little bit later. So Mr. Client with a $100,000 after-tax retirement income goal adjusted for inflation that you want to last between age 65 and age 90. You need assets that can deliver $5.9 million of cumulative after-tax income. You saw that, Mr. Client, on the previous screen. So the next thing we want to know is how much would you need to accumulate by age 65 after tax, assuming a 4% after-tax rate of return on your invested assets, all during retirement, in order to meet the goal? The answer, $3,574,000, almost $3.6 million. So Mr. Client, if you had $3.6 million after tax at age 65, growing at 4%, it would meet your retirement goal adjusted for inflation, and all of that $3.6 million would be gone at age 90. Mr. Client, does this surprise you? Mr. Client, where do you think you stand on the way to reaching this after-tax capital goal necessary to meet retirement? Now, he might say, I really don't know, I think I'm okay, and you're going to come back and basically say, so Mr. Client, let's take a look at really where you stand. So we're going to go back to overview. Now, again, where I like to go once I go back to this overview chart just so he can see it, is I'll click back up on client profile. Now in the client profile, I'll go to tax qualified plan assets. So Mr. Client, about how much do you have in your IRAs, 401ks, pension, or profit sharing plans? He says, I have 500,000. I input. Then I click on the right side of current annual contributions to those plans, highlight it by dragging it to the left. How much are you annually contributing? He says $20,000. I'm going to then go into my assumed rate of return on qualified plan assets. I'm going to highlight it. Mr. Client, what rate of return after investment expenses would you like to assume for your IRAs, 401ks, and pensions? And remember, this is all growing tax-free until you take it out. And he says 6.5%. And so I inputted it. Now notice under years to continue contributions to tax-qualified plans, our default is that he's going to continue the contributions until retirement. You do have an option here if you wanted to limit the number of years for some reason. Other retirement assets. These are assets for retirement, not in an IRA, 401k, or pension. He says, I've got $250,000 in my brokerage account. So, to the extent that a client has other types of assets like a business, rental real estate, we have other ways to deal with that, which we can convert and actually put in here for now. But let's just assume we have a pretty straightforward case, and this client just has money in the bank and a brokerage account, etc., just for purposes of conversation. At this point, I do not make any input where it says current annual retirement contributions to other retirement assets, because I want the system to calculate how much he needs to save without regard to anything he might be doing here. I really, for now, want to consider contributions to his tax-qualified plan, not to this side. Now, again, here, my effective income tax rate, where our default is at 30%, is going to impact what I take out of my tax-qualified plan at retirement. Again, we're assuming a 30% effective tax rate at retirement. Hit save and continue. Here, all of our assumptions come back at us. $500,000 in our qualified plan, contributing $20 a year, all the way through retirement. And assumed rate of return, 6.5%. Again, there's no taxes here on while we're accumulating money. And that he has $250,000 of other retirement assets growing at 4%. Click on Yes, Generate Results. Now, nothing's changed here, of course, on our retirement goal, so I really don't need to reconsider this. So now I'm going to go to step 1. I'll make this a little bigger. And what we see is the projected future value of tax-qualified assets before retirement. So, Mr. Client, you said you've got $500,000 sitting in your IRA, 401k, pension, or profit sharing, contributing $20,000 a year. So between now and right before retirement, remember retirement's at 65, we would expect you to add about $400,000 of contributions to those plans. Now, based on your 6.5% growth rate in tax-qualified assets, which of course is going to go up, down, and sideways, but if it linearly actually grew at 6.5%, you'll notice in year one, we'd expect you to get about $34,000. And you'll see how the growth on your tax-qualified assets is getting larger and larger as interest is earning interest, and the fact that you're also adding money to the account. So with a $500,000 balance at 45, contributing $20,000 a year through until retirement, with an assumed growth rate of 6.5%, we would expect you to actually accumulate about $2.6 million. So everybody, I don't go $2,588,802. I say, Mr. Client, we would expect you to accumulate about $2.6 million at retirement, which is really very impressive. Now, Mr. Client, when you are a client of mine, every year we're going to get together. We're going to look at what did you contribute, what was the actual earnings, and are we tracking what our glide path is to get to this $2.6 million balance. So we'll basically be your guide to your roadmap to a secure future. Continue to step 2. I click on that. Now in step 2, Mr. Client, we're going to look at the projected spend down, meaning money that you're now going to take out of your tax qualified assets. So what the system shows, Mr. Client, is with a beginning balance of $2.6 million, and assuming we're going to get 6.5% growth all the way through and including age 90, the system automatically maximizes the first year of retirement's taxable distribution. And in this example, it came up with a solution of $154,000. So what the system is telling us is if you had a $2.6 million balance at 65, and assuming we could get 6.5% growth, and that we were going to deplete the entire account at age 90, the most you could take out as a taxable distribution in year one of retirement would be $154,000, assuming we wanted that taxable distribution to grow with the inflation rate assumption. So, and again, we're going to end up with 0 at the end of retirement. So we're maximizing what we can take. So the $154,000 number is the maximum number year one. The 158 is 2.5% growth. Every number thereafter is just the taxable distribution growing with your inflation assumption. So Mr. Client, in year one, you could take out $154,000 as a taxable distribution. But with our effective tax rate assumption of 30%, you'd have to pay about $46,000 of taxes, meaning you would net after tax $108,000. Now, Mr. Client, let's write down this $108,000 number, because you're going to see that a little bit later, because that's the amount that you could spend in year one of retirement if you had a $2.6 million account with a 6.5% growth rate and you wanted your distributions to keep pace with inflation, and that at age 90 you expected to pass away. One other thing I'd like to summarize. Mr. Client, with this $2.6 million balance at retirement and your growth assumption of 6.5, it would actually generate about $5.6 million of taxable distributions, but it's going to generate $1.7 million in taxes. You can see the game that the federal government plays. It gives you a tax deduction on the $20,000 that you're putting in, but they're going to hit you pretty hard down the road because you're going to pay income taxes on everything you put in and all of the growth. Now we're going to go to step 3. We're now going to look at your other retirement assets, that is assets outside of your IRA 401k pension. We said you had $250,000 right now, and that we would expect that money to grow at 4% after tax and investment expenses. So again, the system does the same thing, Mr. Client. We would project that 250 to grow to 548,000 at retirement. Click on Continue, Step 4. The system does the same thing, Mr. Client, but here we don't have to worry about taxes on distributions because this is after tax assets that we're looking at. These are not assets in a tax qualified plan. So with a $548,000 balance at age 65 and assuming our 4% growth rate and wanting to spend the money down to zero at death assumed at 90, meaning we're maximizing what you can take out of here. That $548,000 balance would allow you to take out $25,000 the first year of retirement. Let's write down that $25,000 number because we're going to see that on the next page. So again, you'll see that these distributions, which don't have any taxes on them because these are after-tax assets, are growing with inflation. So with a $548,000 balance, assume to grow at 4% after tax and investment expenses, it would actually generate over $900,000 of after-tax income to you. But again, first year of retirement, $25,000. Now we're going to click on Step 5. So Mr. Client, the roadmap is going to put it all together. With a $100,000 after-tax retirement income goal adjusted for inflation, and assuming that we can get 4% after tax on our other assets, let me show you how it all comes together. The first year of retirement, with inflation, we need $164,000. From your tax qualified assets, we can get $108,000. Remember how we wrote that number down? We see that on Step 2. Here's our $108,000 number. Then I'll click back on Step 5. We said we could get $25,000 after tax from our other retirement assets, which we would see in Step 4 right here. So Mr. Client, $100,000 goal, we need $164 after tax the first year of retirement. $108 is coming from our after tax from our 401k and pension, $25 from your other assets, currently worth $250. So combined, we've got $133,000 of after-tax income, which means you're meeting 81% of your goal. We have a shortfall of $31,000 in year one, and you see that shortfall is growing with the inflation. So we actually need to accumulate more money at retirement because we've got to have assets that can deliver an additional $1.1 million of cumulative after-tax retirement income. So this means we've got to accumulate another $671,000 after tax at retirement to meet your goal, assuming we can get 4% after tax on this invested capital. By the way, the entire $671,000 would be gone at age 90. Now, on the very far right side of your screen is another scroll bar, right? It comes with your browser. And I'll just drag that down a little bit until you see, I don't want to really drag it down to include lump sum needed. I want to drag it down where I just get to this place, amount to save annually for 20 years to reach our $671,000 goal. And you'll notice the answer is $21,892. So Mr. Client, what this means is between now, age 45, and until retirement at 65, you would need to save $21,892 in a combination of stocks and bonds at a 4% after-tax growth rate in order to meet the deficiency of $671,000 of capital that we need to accumulate. Now there is a summary tab, so let me grab, I'm going all the way to the right, and you see how I'm grabbing that scroll bar on the far right side? So I'm going to the top of the screen, and I'm now going to click on summary. So Mr. Client, what we've done is compared your projected retirement distributions from your tax qualified plan and your other retirement assets to your annual inflation adjusted retirement goal. And as you see, the system will calculate how much you must start saving today to fund the projected annual shortfall, assuming that 4% after tax and investment fee assumption. Again, you'll remember, Mr. Client, the total after-tax retirement income needs were $5.9 million. Now what I'll do is I'll click on step 5. I'll scroll it down, and there's my $5.9 million number. Scroll it back up, go back to summary. Mr. Client, the total income that was provided by all of your assets was $4.8 million. And again, the cumulative shortfall on an annual basis was $1.1 million. Go back to step 5, scroll it down, and you'll see that shortfall is in red. Here's that $1.1 million number. Now this may all sound a little confusing, but once you've done this a few times, it really becomes second nature. So scroll this back up, go back to summary. So again, Mr. Client, the additional capital that we need is $671,000, and the amount to save annually for the next 20 years to reach that deficiency, $21,892. Now last, what I'd like to show you is when you click down here, Generate PDF, click, the system is going to generate a PDF of everything that you just did. So here you see it actually being generated. And of course, this would have your client name. This would be your information, not mine. And you'll see there it is a 12-page report. So all I did was bring my cursor down, I'll arrow, and it's going to give you a summary of the input. Here's your the impact of inflation on the retirement income goal with some key ages highlighted. And then as you click down, there's your summary of the tax qualified assets before retirement. Here's the summary of your distributions from your tax qualified plan, taxable, the income tax liabilities. By the way, one of the ways that we use IUL to fund retirement is we're going to run an IUL illustration to actually take care of these annual tax liabilities. So now I move my cursor down, this reappears, and again, the next page is going to show you your other retirement assets, and then again, the spend down of those and your shortfall. Now, what you can do at that point, you see where there's this save icon. Click on that, save a copy, and then what I like to do, put my cursor on the right side, and I'm going to highlight that, and I'm going to type the name of the client, Johnson Roadmap. I like to save things quickly on my desktop. Hit save, and it would be on your desktop. And then you can take that save file, just attach it to your email account, and send it to whoever is going to run your sales illustrations in order to do two things. The first one is to pay taxes on qualified plan distributions, and the second IUL illustration is to meet the annual shortfall. This is Joel Solomon of PRS.